All right, here's our favorite here, distribution planning and Roth conversions. Okay, so this one I know everybody loves to talk about here because they know the power of what can happen if you have a good Roth conversion and distribution planning strategy. Okay, so let's talk about this. All right. So distribution planning and Roth conversions are essential components of income planning for retirement. This is a conversation. A lot of advisors, they don't believe that there's a lot of value sometimes in Roth conversions because of whatever reason. I personally do. So if you're somebody who thinks taxes are going to go up in the future, then Roth conversions are something you should definitely consider, especially early in retirement, prior to taking all your income sources. Like, for example, if you have not taken your Social Securities yet or your pensions and you have left your job, super good time to be thinking about Roth conversions. Okay, so Roth conversions will help you manage your income sources, or I should say, and distribution planning. Will help you manage your income sources, taxes, and withdrawal strategies to ensure that you have a stable income during your retirement while minimizing your tax burden. So let's take a look at these concepts in detail. Okay, so distribution planning. So distribution planning involves creating a plan for how you will withdraw money from your various retirement accounts like 401ks, IRAs, or taxable accounts to cover your living expenses during retirement. So generally, you're gonna have 3 buckets of accounts, maybe 401ks or IRAs, which are pre-tax accounts, and you might have some Roth IRAs, and you might have taxable accounts or your bank account just with some cash in it. So, the goal is to find the most tax-efficient way to withdraw your funds while considering factors like required minimum distributions. So required minimum distributions are the distributions that have to come out of your pre-tax accounts now at age 73, and it will be at age 75 if you're born in 1960 or later. You also want to consider things like the tax brackets and your impact on Social Security benefits. So this stuff, again, can get very technical, but this is the conversations why I believe you should really get an advisor if you're somebody who has a large pre-tax retirement account. You may pay a fee for advice, but again, listen, if you're going to do better overall, and you net to the positive by getting advice, then it's good for everybody, right? So a common distribution planning technique is to withdraw first from taxable accounts, followed by tax-deferred accounts like traditional IRAs and 401ks, finally from tax-free accounts. However, the optimal strategy can vary depending on your personal financial situation and tax considerations. Here's a situation I had just this last year, by the way. So I have a client that's a single filer as far as taxes go, and she has been taking distributions from her traditional IRA account just to fund her lifestyle. Well, we were looking at her tax planning at the end of the year around September, and it looked like she was about $4,000 close to going into what's called the IRMA Medicare penalty tax bracket there, or tax impact. So it's $97,000 for a single filer. So if she continued to take her pre-tax IRA withdrawal, she was going to go above $97,000 of MAGI, which is modified adjusted gross income. So that would have cost her an additional about $800 to $900 in penalties for the next 2 years. So just by moving her distribution from pre-tax IRA to Roth IRA for the last couple of months of the year, we saved her $900 just by doing that alone. So these are things, that's just one small example, but these are things that it's not always the case, right? So this is why you want to have somebody helping you, and or at least if you're somebody who's super nerdy and you want to figure this stuff out, it is all online somewhere, but you might not have the tools like I have, like an advisor has, to really help you dig into this stuff, because it's just not something that's just common. It's just there are some good tools online, but these professional tools we have are pretty amazing. And so getting some advice, I usually think, is definitely worth your dollars, right? From your pockets there. So Roth conversions. So let's talk about Roth conversions. Roth conversions are a strategy that involve converting some or all of your tax-deferred accounts, like traditional IRAs or 401ks, into a Roth IRA. Generally, you don't want to do the whole account in 1 year, okay? But when you do a Roth conversion, you're going to pay taxes on the amount converted at your current income tax rate. However, once the funds are in the Roth IRA, they grow tax-free, and you won't owe taxes on qualified withdrawals in retirement. Another benefit is there's no required minimum distributions on Roth IRA. So this can be a very powerful strategy if you're not 73 yet, and you have not started taking required distributions, to really think about to get yourself some money from your pre-tax accounts to your Roth IRAs to give you another bucket to pull from in case you have a situation like I had just mentioned there. So Roth conversions can be a powerful income planning tool for retirement because they allow you to manage your future tax burden by paying taxes at potentially lower rates today. Additionally, Roth IRAs do not have RMD requirements, which gives you more flexibility in managing your retirement and tax situation. I love flexibility. So if you like flexibility, maybe Roth conversions are for you. So to effectively use distribution planning and Roth conversions in your income planning for retirement, consider the following steps. Number one is assess your situation, including the various retirement account balances, tax rates, projected expenses during retirement. If you're somebody who has very low expenses, then distribution planning and Roth conversions could be a huge benefit for you. And our case study is going to touch on that today. But really, really important. Also estimate your retirement income sources like Social Security, pensions, and investment income. Then you want to develop a withdrawal strategy that balances your income needs, tax implications, and the longevity of your retirement assets. And then 4, determine if Roth conversions make sense for you and your tax situation, both now and in the future. So it is essential to review your income strategy periodically. I recommend annually, to make adjustments as needed based on changes in tax laws, your financial situation, or your retirement goals. But the reality is, the way I look at things too is tax planning happens all year. We might have RMD planning. If the market's down like it was last year, 20%, I was doing Roth conversions for clients in this year, like last month and the month before in February, March, and April, because the market's been down quite a bit, more than it has been over the last few years. And so this is a great way that if you can do a Roth conversion while the market's down, and then the market comes back, and you have all that money in a tax-free account like a Roth IRA, that's all going to be tax-free gain. So let's just do an easy example. I did a Roth conversion for a client while one of their accounts was down 20%. Their tax rate was 22%. So when we converted over, I'll just make up a number here, $10,000 from pre-tax to Roth IRA, and that money then comes back. They did pay the 22% on that, so that'd be $2,200. But when it comes back in the Roth IRA, they're going to get a tax-free gain, even this year, which it looks like it's on the right track. Then they're going to make up their tax dollars that way. So very, very powerful. So working with a financial advisor or tax professional can help you ensure that your income planning strategy for retirement is optimized for your unique circumstances. So if I were you and you're looking for help with this from an advisor, you want to ask questions like, do you do retirement income planning? Tell me about your philosophy when it comes to distribution, planning, and Roth conversions. Do you take into account all my full financial situation? It helped me plan for taxes each year, including what account I should pull from, what order, and how I should orchestrate my whole financial picture. If you're not getting that type of help and someone's just only doing investments and they're saying, don't worry about it, you're okay, you're fine, and they're not sitting down with you and helping you understand how to integrate your whole plan, again, these are things that, again, it's your money at the end of the day. I'm just trying to help you do the best thing you can do for yourself. And like I said, I had a comment last week from somebody who said their financial advisor was very upset with them because they started asking questions like I recommended that they ask. But I believe that we need to do more for clients than just simply do investments as certified financial planners especially, and as a true fiduciary, we need to look at the whole picture, okay? So if you're not getting that, again, it's okay to shop around. There's a lot of good advisors out there.